Question 1. Underwriting process. An insurance underwriter receives an application from a 45-year-old applicant who participates in recreational skydiving. The applicant has a stable job and excellent credit, but he has a history of minor health issues such as high cholesterol. Which underwriting action is most likely to occur? A. The policy will be issued at a standard rate with no modifications. B. The policy will be declined due to the applicant's high-risk activities. C. The policy will be issued with substandard rating due to increased risk factors. D. The policy will be issued with preferred rating due to the applicant's financial stability. Answer C. The policy will be issued with a substandard rating due to increased risk factors. Explanation. Underwriting involves risk assessment and classification to ensure that the insurer can manage potential claims without financial losses. In this case, the applicant presents a higher than average risk due to his participation in a hazardous activity, skydiving. The underwriter will likely issue the policy with a substandard rating to account for the elevated risk. Relevant guidelines include the risk selection and classification process and the impact of lifestyle choices on underwriting decisions. Incorrect option A. Issuing the policy at a standard rate would not account for the increased risk posed by skydiving. Incorrect option B. The policy is unlikely to be outright declined unless the activity is extremely frequent or the applicant refuses to accept modifications. Incorrect option D. A preferred writ, reserved for applicants with low-risk profiles, excellent health, and no hazardous activities. Question 2. Legal and ethical considerations. Scenario-based. Mr. Thompson, an insurance producer in Pennsylvania, is assisting client with replacing their current life insurance policy. The client is unaware of the potential financial consequences of cancelling the existing policy. What is Mr. Thompson required to do under Pennsylvania law before proceeding with the policy replacement? A. Advise the client to immediately cancel the existing policy to avoid paying two premiums. B. Provide written comparison of the new policy and the existing policy, highlighting any differences. C. Submit the client's new application to the insurer without discussing the existing policy. D. Recommend the policy replacement only if it will significantly reduce the client's premiums. Answer B. Provide a written comparison of the new policy and the existing policy, highlighting any differences. Explanation. Under Pennsylvania replacement regulations, producers must ensure that clients fully understand the implications of replacing an insurance policy. Providing a written comparison helps the client make an informed decision by clearly showing the differences in coverage premiums and potential cash value loss. Incorrect option A. The client to cancel the existing policy without understanding the implications could result in financial harm and is considered unethical. Incorrect option C. The producer must address the client's current coverage and provide suitable advice. Incorrect option D. While cost is factor, it is not the only consideration. Suitability of coverage is paramount. Relevant laws: Pennsylvania Insurance Department regulations on policy replacement, ethical practices and consumer protection guidelines. Question 3. Insurance policies. A homeowner's insurance policy includes an exclusion clause for damage caused by floods. The insured suffers significant water damage after severe storm causes nearby river to overflow. How will the insurer most likely handle the claim? A. The insurer will pay the full claim because storm damage is covered peril. B. The insurer will partially cover the claim, deducting the cost of flood-related damage. C. The insurer will deny the claim because flood damage is specifically excluded. D. The insurer will offer to modify the policy to cover future flood damage. Answer C. The insurer will deny the claim because flood damage is specifically excluded. Explanation. Most homeowners' insurance policies exclude flood damage, requiring homeowners to purchase separate flood insurance policies through programs such as the National Flood Insurance Program and FIP. In this case, the exclusion clause explicitly removes flood-related claims from coverage, and the insurer is within its rights to deny the claim. Incorrect option A. Storm damage is generally covered, but flooding is distinct exclusion in most policies. Incorrect option B. Insurers do not typically offer partial coverage for excluded perils. Incorrect option D. Policy modifications for future coverage must be requested in advance and are not offered as part of claim settlement. Relevant laws: NFIP guidelines, policy exclusions and conditions under Pennsylvania Insurance Regulations FEC, Settlement Practices Act. Question 4. Risk assessment and classification. An insurer is determining the premium for A life insurance policy based on the applicant's mortality rate, occupation, and lifestyle choices. Which of the following would most likely result in substandard rating? A. The applicant is 30-year-old non-smoker with stable desk job. B. The applicant is 45-year-old pilot who occasionally smokes cigars. C. The applicant is 55-year-old retiree with no significant medical history. D. The applicant is 25-year-old fitness instructor with family history of heart disease. Answer: B. The applicant is a 45-year-old pilot who occasionally smokes cigars. Explanation: in underwriting, insurers assess risk factors such as age, occupation, lifestyle choices, and medical history. A substandard rating is typically given to individuals with higher than average risk profiles. In this case, the applicant's occupation, pilot, and smoking habit increases risk of mortality. Incorrect option A. 30-year-old non-smoker. Stable job would likely qualify for preferred or standard rating. Incorrect option C. 55-year-old retiree with clean medical history would likely receive standard rating. Incorrect option D. Family history is consideration, but it would not typically result in an immediate substandard rating. Question 5. Insurance regulation. According to Pennsylvania insurance regulations, which of the following would not be considered? A prohibited practice for a licensed insurance producer. A. Misrepresenting the terms of an insurance policy to a client. B. Rebasing part of the commission to a client as an incentive. C. Refusing to disclose commission details when asked by a client. D. Offering additional coverage for free as part of the sale. Answer: C. Refusing to disclose commission details when asked by a client. Explanation: under Pennsylvania law, insurance producers are not required to disclose commission details unless it is specifically related to conflict of interest or fiduciary responsibilities. However, misrepresentation, rebating, and offering inducements are prohibited under Pennsylvania's Unfair Trade Practices laws. Relevant guidelines: Pennsylvania Unfair Insurance Act, UIPA, rebating and inducement rules under Pennsylvania law. Question 6. Legal and ethical considerations. Scenario-based IMIS. Garcia, licensed insurance producer in Pennsylvania, notices that client has provided false information on their application to secure lower premium. What should IMIS Garcia do in this situation? A. Submit the application as is and allow the underwriter to address the issue. B. Correct the information herself and submit the updated application. C. Inform the client that providing false information can result in policy cancellation or legal consequences. D. Cancel the client's application and report them to the Pennsylvania Insurance Department. Answer: C. Inform the client that providing false information can result in policy cancellation or legal consequences. Explanation: insurance producers have a legal and ethical responsibility to ensure that clients provide accurate information. If false information is submitted, it could lead to policy cancellation, claims denial, or fraud charges. The producer must educate the client about the importance of honest disclosure of relevant laws. Pennsylvania Insurance Fraud Prevention Act. Ethical practices for producers. Consequences of misrepresentation in applications. Question 7. General insurance concepts. Which of the following best describes the concept of adverse selection in insurance underwriting? A. The tendency of higher-risk individuals to seek insurance more often than low-risk individuals. B. The process of grouping individuals with similar risk profiles to determine premiums. C. The practice of insurers denying coverage to individuals based on pre-existing conditions. D. The act of transferring risk from one party to another through an insurance policy. Answer A. The tendency of high-risk individuals to seek insurance more often than low-risk individuals. Explanation: adverse selection occurs when individuals with higher risk are more likely to purchase insurance, while low-risk individuals are less likely to do so. This can result in financial instability for insurers if not properly managed through underwriting practices. Incorrect option B. This describes risk classification, not adverse selection. Incorrect option C. Denying coverage based on pre-existing conditions is related to policy provisions and regulatory compliance. Incorrect option D. This defines risk transfer, not adverse selection. Relevant guidelines. Risk management principles. Adverse selection in underwriting. Question 8. Insurance policies. A policyholder has a homeowner's insurance policy with an endorsement that covers earthquake damage. Which part of the policy would this endorsement modify? A. Declarations. B. Conditions. C. Exclusions. D. Insuring agreement. Answer D. Insuring agreement. Explanation. An endorsement is a policy modification that changes the insuring agreement to provide additional coverage. In this case, the earthquake damage endorsement would expand the policy's coverage beyond the standard insuring agreement. Incorrect option A. The declarations section outlines policy details but does not define coverage modifications. Incorrect option B. Conditions specify rules and obligations, not coverage changes. Incorrect option C. Exclusions define what is not covered, but endorsements add coverage. Relevant guidelines, policy structure, endorsements and riders. Question 9. Claims and policy benefits. Which of the following is true about the claims process under Pennsylvania law? A. Insurers must accept or deny a claim within 60 days of receiving notice of loss. B. Insurers are required to provide claim forms within 10 business days of receiving notice of loss. C. Claimants must submit proof of loss within 30 days of receiving claim forms. D. Insurers must settle all claims within 90 days of receiving notice of loss. Answer. B. Insurers are required to provide claim forms within 10 business days of receiving notice of loss. Explanation. Under Pennsylvania claims regulations, insurers must promptly respond to claims by providing claim forms within 10 business days of receiving notice of loss. Failure to do so can result in penalties under Unfair Claims Settlement Practices. Relevant laws: Pennsylvania Unfair Insurance Practices Act, Fair Claims Settlement Practices Act. Question 10. Marketing practices. A producer in Pennsylvania places advertisements for a new life insurance policy. Which of the following would be considered a violation of Pennsylvania's advertising regulations? A. Stating that the policy includes optional riders for additional coverage. B. Using language that implies guaranteed rate of return on investment. C. Promoting policy feature that reduces premiums after 10 years. D. Providing contact information for inquiries. Answer. B. Using language that implies a guaranteed rate of return on investment. Explanation. Pennsylvania's advertising regulations prohibit misleading statements in advertisements, including claims of guaranteed returns. Life insurance is not an investment vehicle, and guaranteed returns cannot be promised. Relevant laws: Pennsylvania Insurance Department advertising rules, unfair trade practices laws. Question 11. Homeowners insurance. Replacement cost versus actual cash value. Homeowners policy covers personal property on an actual cash value (ACV) basis. What is the insured entitled to receive in the event of loss? A. The current market value of the item. B. The replacement cost of the item. C. The original purchase price of the item. D. The replacement cost minus depreciation. Answer. D. The replacement cost minus depreciation. Explanation. Actual cash value (ACV) is the replacement cost of the item minus depreciation. This means that the insurer will pay the insured based on the item's value at the time of the loss, not its original purchase price or full replacement cost. Question 12. Pennsylvania workers' compensation law. Under Pennsylvania law, which of the following injuries would not be covered by workers' compensation insurance? A. An injury caused by a workplace accident. B. An illness caused by exposure to harmful chemicals at work. C. An injury caused by the employee's own intoxication. D. An injury that occurs during an employer-approved break. Answer. C. An injury caused by the employee's own intoxication. Explanation. Pennsylvania workers' compensation laws provide coverage for workplace injuries and illnesses. However, injuries caused by intoxication, self-inflicted harm, or criminal activity by the employer are not covered. Question 13. Scenario-based. Cancellation notice requirements scenario. Pennsylvania insurance company decides to cancel commercial property policy for non-payment of premium. What is the minimum number of days notice the insurer must provide to the insured? A. 10 days. B. 15 days. C. 30 days. D. 45 days. Answer A. 10 days. Explanation. In Pennsylvania, insurers must provide at least 10 days notice before cancelling a policy due to non-payment of premium. For other reasons, longer notice periods may apply. Question 14. Legal concepts. Warranties versus representations. Which of the following statements about warranties in an insurance contract is true? A. Warranties are minor details that can be changed without consequence. B. Warranties are considered guarantees that must be strictly followed. C. Warranties are statements made by the insurer about policy limits. D. Warranties are optional provisions that benefit the insured. Answer B. Warranties are considered guarantees that must be strictly followed. Explanation. A warranty in an insurance contract is a guarantee made by the insured that certain facts or conditions will remain true. If a warranty is violated, it can lead to a denial of coverage. Question 15, scenario-based. Claim settlement scenario. Policyholder submits claim for roof damage caused by windstorm. The insurer investigates the claim and finds that part of the damage was due to normal wear and tear. How should the claim be handled? A. Deny the entire claim due to wear and tear. B. Pay for the entire claim, including wear and tear. C. Pay only for the damage caused by the windstorm. D. Deny the claim if the policyholder cannot prove the cause of damage. Answer C. Pay only for the damage caused by the windstorm. Explanation. Insurance policies cover sudden and accidental losses, but they typically exclude normal wear and tear. The insurer is responsible for paying only for the covered peril, the windstorm damage. Question 16, Pennsylvania Fair Claims Practices. Which of the following actions would be considered an unfair claims practice under Pennsylvania law? A. Requesting additional documentation from the insured. B. Denying a claim without conducting a reasonable investigation. C. Offering a settlement lower than the policy limit. D. Providing written notice of claim denial. Answer B. Denying a claim without conducting a reasonable investigation. Explanation. Under Pennsylvania's Unfair Insurance Practices Act (UIPA), insurers must conduct reasonable investigation before denying claim. Failing to do so is considered an unfair claims practice. Question 17. Risk management techniques. Which of the following is an example of risk transfer in risk management? A. Installing a fire alarm to reduce the risk of fire. B. Avoiding dangerous activities. C. Purchasing insurance to cover potential losses. D. Setting aside funds to pay for potential losses. Answer C. Purchasing insurance to cover potential losses. Explanation. Risk transfer involves shifting the financial burden of a risk to another party, such as an insurer, through the purchase of an insurance policy. Question 18, scenario-based. Replacement cost versus CV scenario. An insured's furniture is destroyed in house fire. The replacement cost of the furniture is $10,000, but its depreciated value is $6,000. The insured's homeowner policy includes replacement cost coverage. How much will the insurer pay? A. $6,000. B. $10,000. C. $4,000. D. Nothing, since the insured must pay out of pocket first. Answer B. $10,000. Explanation. When a policy provides replacement cost coverage, the insurer pays the full replacement cost of the damaged item without deducting for depreciation. Question 19. Insurance fraud. Which of the following actions would be considered insurance fraud in Pennsylvania? A. Filing a claim for legitimate property damage. B. Exaggerating the value of items lost in a theft. C. Not reporting a claim immediately after it occurs. D. Requesting a claim payout in installments. Answer B. Exaggerating the value of items lost in a theft. Explanation. Insurance fraud includes knowingly misrepresenting or exaggerating facts to obtain a higher payout from an insurer. Question 20. Insurable interest. Life insurance. In Pennsylvania, when must insurable interest exist for life insurance policy to be valid? A. Only at the time of the insured's death. B. Only at the time of application. C. At both the time of application and the time of death. D. Insurable interest is not required for life insurance. Answer B. Only at the time of application. Explanation. For a life insurance policy to be valid in Pennsylvania, insurable interest must exist at the time of application. Once the policy is issued, insurable interest is no longer required. Question 21. Underwriting. Risk classification. Which of the following best describes substandard risk in life insurance underwriting? A. An applicant with no health issues and stable occupation. B. An applicant who engages in hazardous activities such as skydiving. C. An applicant who is over the age of 50. D. An applicant who applies for policy with high death benefits. Answer B. An applicant who engages in hazardous activities such as skydiving. Explanation. A substandard risk refers to an applicant who presents a higher than average risk to the insurer due to factors such as poor health, hazardous occupations, or dangerous hobbies. These risks may result in higher premiums or policy exclusions. Question 22. Legal concepts. Elements of legal contract. Which of the following is not one of the essential elements of legal contract? A. Offer and acceptance. B. Consideration. C. Competent parties. D. Disclosure of financial status. Answer D. Disclosure of financial status. Explanation. The four essential elements of a legal contract are offer and acceptance, mutual agreement between parties, consideration, something of value exchanged, competent parties. Parties must have legal capacity, legal purpose. Contract must be lawful. Disclosure of financial status is not required element for legal contract. Question 23, scenario-based. Advertising regulations. Scenario. An insurance agent in Pennsylvania places an advertisement stating that their life insurance policies are guaranteed to pay double the death benefit in all cases. Is this advertisement compliant with Pennsylvania insurance regulations? A. Yes, as long as the policy includes double indemnity clause. B. Yes, because the insurer can guarantee the payout. C. No, because it is misleading and deceptive advertising practice. D. No, unless the policyholder has specific endorsement. Answer C. No, because it is a misleading and deceptive advertising practice. Explanation. Pennsylvania's Unfair Insurance Practices Act (UIPA) prohibits misleading, deceptive, or false advertising in insurance. Advertising must be truthful and accurate, and the insurer must clearly explain any conditions or limitations. Question 24, Fair Credit Reporting Act of CRO. Under the Fair Credit Reporting Act of CRO, which of the following is required when an insurer uses consumer report to make an underwriting decision? A. The insurer must notify the applicant if policy is issued. B. The insurer must provide copy of the report to the applicant. C. The insurer must obtain the applicant's written consent before accessing the report. D. The insurer must notify the applicant if an adverse decision is made based on the report. Answer D. The insurer must notify the applicant if an adverse decision is made based on the report. Explanation. The IFCRO requires insurers to provide adverse action notices if a consumer report is used to make a negative underwriting decision. The notice must include the name of the reporting agency and inform the applicant of their right to dispute the report. Question 25. Policy structure. Exclusions. Which of the following is an example of policy exclusion commonly found in homeowners insurance policy? A. Theft of personal property. B. Fire damage to the home. C. Flood damage to the home. D. Liability for injuries on the property. Answer C. Flood damage to the home. Explanation. Flood damage is typically excluded from standard homeowners policies. Homeowners must purchase a separate flood insurance policy to cover flood-related losses. Question 26, scenario-based. Risk management scenario. Maria owns small bakery. To protect against potential liability claims, she purchases general liability insurance. Which risk management technique has Maria used? A. Risk avoidance. B. Risk retention. C. Risk transfer. D. Risk reduction. Answer C. Risk transfer. Explanation. By purchasing insurance, Maria has transferred the financial burden of liability claims to the insurer. This is a key example of risk transfer in risk management. Question 27. Claims handling. The investigation of claims in Pennsylvania. What is the first step an insurer must take after receiving notice of claim? A. Immediately deny the claim if there are no witnesses. B. Begin an investigation of the claim. C. Request the claimant to withdraw the claim. D. Pay the claim immediately without investigation. Answer B. Begin an investigation of the claim. Explanation. Under Pennsylvania law, insurers must begin investigating a claim promptly upon receiving notice of loss. The investigation ensures that the claim is valid and that the loss is covered by the policy. Question 28. Reinsurance. Purpose of reinsurance. What is the primary purpose of reinsurance in the insurance industry? A. To eliminate the need for underwriting. B. To reduce the insurer's financial risk by sharing it with other insurers. C. To guarantee policyholders receive higher benefits. D. To increase the premium charged to policyholders. Answer B. To reduce the insurer's financial risk by sharing it with other insurers. Explanation. Reinsurance is practice where insurers transfer some of their risks to other insurance companies to reduce their exposure to large claims. It helps insurers maintain financial stability. Question 29. Privacy protection. Gramm-Leach-Bliley Act. The Gramm-Leach-Bliley Act requires insurers to do which of the following? A. Provide consumers with privacy notice explaining how their personal information is used. B. Disclose the insurer's financial stability to all policyholders. C. Share personal data with third parties without restrictions. D. Eliminate all underwriting criteria. Answer A. Provide consumers with a privacy notice explaining how their personal information is used. Explanation. The Graham-Leach-Bliley Act GBA requires insurers to provide consumers with a privacy notice that outlines how personal information is collected, used, and protected. Consumers must also be given the option to opt out of certain information sharing. Question 30. Ethical practices. Producer responsibilities. Which of the following is an ethical obligation of an insurance producer in Pennsylvania? A. Recommending the most expensive policy to earn higher commission. B. Advising clients to cancel existing coverage without explaining the consequences. C. Keeping clients' funds separate from personal funds. D. Refusing to provide written documentation of policy details. Answer C. Keeping clients' funds separate from personal funds. Explanation. Producers have a fiduciary duty to their clients, which includes keeping clients' funds separate from their own funds. This ensures that funds are handled ethically and responsibly.